Stop guessing. 5 signs an investment is worth your money.
What if I told you that one of the biggest reasons people lose money in investing has nothing to do with intelligence, education, or even how much money they start with? Every day, thousands of people invest based on social media trends, hot tips from friends, YouTube recommendations, celebrity endorsements, and pure excitement. Some get lucky. Most do not. The truth is that successful investors do not make decisions the way most people do. They do not chase hype. They do not buy simply because a stock is going up. And they definitely do not invest because someone on the internet promised huge returns. Instead, they use a simple framework to determine whether an investment is actually worth their money. And today, I am going to show you exactly what that framework looks like. By the end of this video, you will know the 5 signs that experienced investors look for before investing a single dollar, naira, pound, or euro. These principles have been used by some of the most successful investors in history, including Warren Buffett, Charlie Munger, and Peter Lynch. And if you apply them consistently, they can help you avoid costly mistakes while dramatically improving your investment decisions. Let us begin. Why most people fail at investing. Before discussing what makes an investment attractive, let us talk about why so many people struggle. Most investors start with the wrong question. They ask, "What should I buy?" But successful investors ask, "Why should I buy it?" That difference may sound small. It is not. Most people focus on opportunities. Successful investors focus on quality. Think about it. When a stock doubles, everyone starts talking about it. When cryptocurrency prices soar, social media becomes filled with stories of overnight millionaires. When a new business trend emerges, people rush to participate. This creates a dangerous cycle. People see prices rising. They assume prices will continue rising. They buy. Prices eventually fall. Fear takes over. They sell. Then they repeat the process with the next exciting opportunity. This pattern destroys wealth. As legendary investor Benjamin Graham said, the individual investor should act consistently as an investor and not as a speculator. Speculators chase excitement. Investors pursue value. The difference between those two approaches can determine whether you build wealth or continuously struggle to grow your money. And now let us discuss the first sign of a worthwhile investment. Sign 1. You understand how it makes money. This sounds obvious, yet it is one of the most ignored principles in investing. According to Warren Buffett, never invest in a business you cannot understand. Simple. Powerful. Often ignored. Many investors buy things they cannot explain. Ask them how the company generates revenue. They do not know. Ask them who the customers are. They are not sure. Ask them why the company has an advantage. Silence. If you do not understand how an investment creates value, you are gambling more than investing. Now, understanding does not mean becoming an expert.
The opportunity.
You do not need a finance degree. You do not need to analyze every line of a financial report. You simply need to understand the basics. Ask these questions. What does the company sell?
This product line is exactly what we need.
Who buys it? Why do customers choose it? How does it generate profits? What risks could hurt the business? If you can answer these questions confidently, you are already ahead of many investors. Let us imagine 2 businesses. The first sells software subscriptions to businesses. Customers pay monthly fees. The company earns recurring revenue. Easy to understand. The second business uses highly complex financial structures that require multiple explanations before you even understand the product. Which one would you feel more comfortable owning? Probably the first. Complexity often creates unnecessary risk. The greatest investors in history understand that simplicity can be incredibly powerful. Just because something sounds sophisticated does not mean it is a good investment. In fact, complexity sometimes hides weaknesses. One of the smartest things you can say as an investor is, "I do not understand this." Because when you admit what you do not know, you protect yourself from costly mistakes. Sign 2. The numbers support the story. Every investment comes with a story. A company might claim it is disrupting an industry. A startup may promise explosive growth. A new technology could be described as revolutionary. Stories attract attention. Numbers reveal truth. This is where many investors go wrong. They'll fall in love with narratives. They ignore financial reality. As Buffett famously said, "Price is what you pay. Value is what you get. So what numbers should you pay attention to? Revenue growth. Is the company increasing sales consistently? Revenue growth often indicates demand. People are buying the product. Customers are returning. The business is expanding. Strong revenue growth is usually a positive sign, but it is not enough by itself. A company can grow revenue while losing enormous amounts of money. That is why we look deeper.
The growth numbers look clean, but the underlying metrics tell a different story. Someone wants to keep this buried.
Profitability. Can the company actually make money? Profitability demonstrates that the business model works. Many companies can generate sales. Far fewer can generate sustainable profits. The businesses that consistently earn profits often have stronger foundations. Cash flow. Cash is the fuel of every business. Without cash, growth becomes difficult. A company may report profits on paper, but if cash is not entering the business, problems can emerge. Strong cash flow provides flexibility. It allows companies to invest, innovate, hire talent, and survive difficult economic periods. Debt can help businesses grow. But too much debt creates danger. Think of debt like fire. Used carefully, it can be helpful. Used recklessly, it becomes destructive. Always ask, can this company comfortably manage its debt obligations?
Our foundation is strong enough to carry every obligation with confidence.
If economic conditions worsen, will it survive? Many businesses fail not because they lack customers, but because they carry excessive debt. The lesson here is simple. Never invest based solely on promises.
Visuals are just distraction. I want the data.
Verify the numbers.
I want evidence over hype.
Because eventually, reality catches up to every story. Sign 3. The business has a competitive advantage. Imagine opening a coffee shop tomorrow. How difficult would it be for someone to open another coffee shop next door? Not very difficult. And imagine trying to compete with a global brand that millions of customers trust. Much harder. This is where competitive advantage becomes important. According to Charlie Munger, the key to investing is determining the competitive advantage of any given company and, above all, the durability of that advantage. A competitive advantage helps a company protect profits and maintain growth. Let us examine a few examples. Brand power. Some brands are incredibly valuable. Customers trust them. They recognize them instantly. They often choose them even when cheaper alternatives exist. Strong brands create loyalty. Loyal customers generate recurring revenue. Network effects. Some businesses become more valuable as more people use them. Think about social platforms or marketplaces. Users attract other users. Growth reinforces growth. These businesses often become difficult to compete against. Switching costs. Certain products become deeply integrated into people's lives or businesses. Changing providers becomes inconvenient or expensive. As a result, customers stay. This creates stability. Patents and innovation. Companies that develop unique products sometimes receive legal protections. These protections can provide years of advantage. Competitors cannot easily replicate the innovation. Scale. Large businesses often benefit from efficiency. They negotiate better prices. Invest more in research. Reach more customers. Operate more effectively. Whenever you are analyzing an investment, ask what prevents competitors from copying this success. If the answer is nothing, caution is warranted because competition eventually pressures profits. Strong businesses have defenses. Weak businesses rely on hope. Sign 4. Management matters more than most people think. Imagine owning the perfect business. Great products. Strong demand.
System capacity at critical levels. Demand exceeds supply across all major sectors.
Excellent financials. Now imagine poor leadership running it.
This set in.
The business begins making bad decisions. Resources are wasted. Opportunities are missed. Growth slows. This is why management matters. Buffett once said, "The single most important decision in evaluating a business is management." Great leaders allocate capital wisely. They communicate honestly. They focus on long-term success rather than short-term appearances.
The ledger doesn't
One of
add
the
up.
easiest ways to evaluate management is to study their actions instead of their
Buried
promises.
this. The ledger doesn't add up. Someone buried this.
Anyone can make ambitious predictions.
We will redefine the industry standards before the decade ends.
The question is, have they delivered results? Look for leaders who admit mistakes.
I take full responsibility for this oversight, and we will rectify it immediately. Your trust is earned through action, and I am committed to restoring it.
Communicate transparently. Execute consistently. Think long-term. Treat shareholders fairly. Another useful indicator is insider ownership.
The stakes are shared. The vision is unified. Together, we secure the future.
When executives own substantial shares, their interests often align with investors. If the business succeeds, they benefit. If it struggles, they share the pain.
We face this storm together, not alone.
That alignment can encourage better decisions. Remember, even great businesses can suffer under poor leadership. Never underestimate the importance of management quality. Sign 5. The investment fits your goals. This is one of the most overlooked investing principles. A great investment for one person may be completely wrong for another. Your financial goals matter. Your timeline matters. Your risk tolerance matters. Consider two investors. One is 25 years old and investing for retirement. The other needs money for a home purchase in 2 years. Should they use the same strategy? Probably not. Different goals require different approaches. As Buffett famously noted, risk comes from not knowing what you are doing. Understanding your own situation is just as important as understanding the investment itself. Ask yourself, why am I investing? When will I need this money? How much volatility can I tolerate? What level of risk feels comfortable? These questions help determine whether an opportunity truly fits your needs. Many investors discover too late that they took more risk than they could emotionally handle.
I see the peak.
When markets decline, panic takes over. They sell. Losses become permanent. Successful investors build portfolios they can hold through difficult periods. That is one reason diversification remains important. As Nobel Prize-winning economist Harry Markowitz famously said, "Diversification is the only free lunch in finance."
Markets breathe life into abstract theory. Every equation tells a story of human foresight.
Diversification cannot eliminate risk, but it can reduce unnecessary risk, and that matters. A successful investment. Let us put these principles into action. Imagine analyzing a company before investing.
Looking at the Q3 projections here.
You discover strong revenue growth, consistent profitability, excellent cash flow, manageable debt, strong competitive advantages. Trusted leadership.
It you said you want your hold, and everything is strong governor nation.
Products customers love.
This product changed everything for our business.
Your support team is incredible.
You understand how the business earns money. The financials support the story. Management has a proven track record. The investment fits your long-term goals. Would such an opportunity guarantee success? No, nothing does. But the odds would likely be far more favorable than blindly chasing trends. This is how experienced investors think. They focus on probabilities, not predictions. A failed investment. And you consider the opposite. A company receives enormous attention online. Influencers promote it constantly. The stock price rises rapidly. People rush to buy. But deeper analysis reveals weak profits, heavy debt, declining cash flow. No competitive advantage. Overly optimistic management claims.
We are committed to a future of unprecedented growth and transparency. Wall Street.
Eventually, reality catches up. Growth slows. Investors panic. The stock collapses. The lesson: popularity is not quality. Attention is not value. Always do your homework. The biggest psychological mistakes investors make. Most investing mistakes are psychological, not intellectual. People know what they should do, but emotions interfere.
We can't let the numbers slip. Too volatile.
Common mistakes include fear of missing out, people buy because everyone else is buying, panic selling, markets decline, fear takes over, investors sell at the worst possible time, overconfidence. Success
We are
creates false
safe.
certainty.
We have won. The future is ours.
Risk increases. Mistakes
Looking at the
multiply.
numbers, the risk tolerance is just off. Each misstep is connected to the next, creating this chain reaction.
Short-term thinking. Investors focus on daily price movements instead of long-term value creation. Successful investing requires emotional discipline, because controlling your emotions often matters more than predicting markets. A simple investment checklist. Before investing, ask, do I understand how it makes money? Do the financials support the story? Does it possess a competitive advantage? Is management trustworthy and capable? Does it fit my goals and risk tolerance?
The long-term growth potential here outweighs the immediate volatility. This roadmap aligns perfectly with our strategy.
If you cannot confidently answer yes to these questions, more research may be necessary. Simple. Practical. Effective. The difference between successful investors and unsuccessful investors is rarely intelligence. More often, it is discipline.
The noise is just decoration. Strategy is the only anchor that holds. Steady hands, steady returns. Chaos cannot shake the foundation.
The best investors do not chase excitement. They evaluate opportunities carefully.
The risk-adjusted returns here don't align with our long-term growth projections. However, if we leverage our competitive advantage in AI integration, the valuation floor shifts significantly. I'm going to recommend the pivot.
They focus on fundamentals. They think long-term, and they follow a process. Remember the 5 signs. 1. You understand how it makes money. 2. The numbers support the story.
Company narrative aligned perfectly with financial charts and performance metrics, facts and claims matching.
3. It has a durable competitive advantage. 4. Management demonstrates integrity and competence.
I see the numbers align perfectly with our projections. Accountability measures are clear, and I am fully confident in this direction. Our commitment.
5. It fits your goals and risk tolerance. Master these principles, and you will already be ahead of many investors. As investor John Templeton famously warned, the 4 most dangerous words in investing are, "This time it is different." The next time you are tempted by a hot tip, viral trend, or exciting prediction, come back to these 5 signs. They will not guarantee success, but they can help you make smarter decisions and avoid expensive mistakes. If you found this video valuable, make sure to subscribe and turn on notifications so you never miss future videos on investing, wealth building, business, personal finance, and financial freedom. Every week, we break down complex financial topics,
Complex financial concepts transforming into simple visual diagrams and step-by-step
into simple, actionable lessons designed to help you make better decisions with your money. If you learned something new today, leave a comment below with the investment rule you think is most important. And if you know someone who constantly asks, "What should I invest in?" share this video with them. Thanks for watching.